Hello and welcome to InvestFlow. Today we'll be talking about my personal stock portfolio and how it changed in February. I was pretty active and bought a lot of stuff and even sold out of one of my positions. So let's find out. These are the things I want to talk about today. The first one will be my portfolio goal. The goal of my portfolio is to build wealth and not to focus on dividends doing so. I want to have a high conviction in all of my holdings and I want to sleep well at night, which goes hand in hand in my opinion. And the ultimate goal is financial freedom, so that I don't rely on my primary income from a 9 to 5 job anymore, that I'm free to do whatever I want. I divide my portfolio into 5 different categories. The biggest category is great capital allocators with around 30% of my portfolio. These are companies that are great at allocating their capital, so the free cash flows that they are generating from the operating businesses. The second biggest category is American tech. So these are basically just software companies out of America, not really anything else besides it. They are operating in different niches, they are offering different products, but the one thing they share is that they are from America and that they are software businesses for the most part. The third category with 25% is high growth. These are often unprofitable companies. The fourth one are others, so companies that didn't really fit in any of these categories. And the smallest category is China, with just little under 4%. I bought 5 stocks in the last month. The first one, which I actually bought in 2 different points of the month, I think at the beginning and towards the end, was ASML. The world leader, the market leader with around 100% market share in extreme ultraviolet lithography and around 80% market share in deep ultraviolet lithography. So pretty much one of the most important companies in the world and my highest conviction stock actually. Another semiconductor I bought was Texas Instruments. I bought them around $170. They are also one of my great capital allocators, where I'm very bullish on. Then I also bought Fiverr after the earnings when they dipped a little bit at around $78. I also bought Danaher and Microsoft right at the smaller correction after the whole tension between Ukraine and Russia started. So I managed to grab a few shares of Danaher and of Microsoft at 250 and $271. I think it actually was on the day that the American exchanges were closed, but since I'm in Germany, I could still buy shares. I also continued to dollar cost average into some other holdings. I did dollar cost average into Amazon, into Alphabet, into Constellation Software, BlackRock, Spotify, and Sartorius. Not much to it, but I did put a one-time saving plan in for Spotify and Sartorius. I don't have, I don't normally have monthly payments in those. Especially Spotify, I'm kinda on the edge right now. Might sell out the company. I will decide that in the future, and I will make a update probably in case I do. I did sell out of JD.com, which was I think my 5th largest position actually. So quite a big position of my portfolio actually. I sold them at around $72 per share. The reason why I sold is that I'm not really too comfortable with companies anymore that produce pretty much all of their revenue in China. We've seen that the regulatory environment is pretty hostile and I don't really think that it will get a lot better in the future. So I don't know. JD also operates on low margins. So for example, what the government did recently is they forced delivery companies like Meituan to raise the prices, or sorry, to sell, to lower the fees that they are collecting. So basically they took a low margin business and made it pretty much into a break even business at best. So I'm not really comfortable having JD.com with the low e-commerce margins, and I don't really feel comfortable about the logistics business also, because I feel like this could get regulated too, or maybe have like price subsidies that the company has to pay or something like that, like deliveries have. So yeah, I'm just not really comfortable holding the company. It also did a pretty nice recovery and I managed to sell it at a small profit. And I just think that there are a lot of better and safer alternatives in the market right now. Before I show you the complete portfolio, would kindly ask you to thumbs up the video and subscribe to the channel. I would also encourage you to follow me on Twitter at stonkmetal, and also please leave a comment down below in case you have any questions or want to share how your own portfolio did. So let's continue with the video now. My performance in the last month was better than the S&P 500. My portfolio went up by around 2.5%, while the S&P was pretty much flat. You can see that they traded pretty close to each other though, with a lot of volatility. But especially towards the end of the month I had a better recovery, so yeah. 1 month doesn't really mean anything, so yeah, I'll take it. I'm happy about it. Now let's take a look at my full portfolio. My largest position with around 11% is ASML, which I bought a few shares of. The second position is Teladoc, which used to be a much larger position, but a few months ago I decided to split up the money a bit and put more money into my other high growth companies like C Limited, Spotify and Fiverr. The other companies in my top 5 are Microsoft, Danaher and Constellation Software, around 7%. Then I also have a few other high convictions, around 6%, with Texas Instruments and Mercado Libre. In the next month I want to get my positions in Amazon and Alphabet into the top area too, so I'm gonna buy more of those. And yeah, besides that I also have BlackRock, Viva Systems, Adobe at the 4% mark, and around 3% I have Nintendo, C Limited, Xiaomi, Salesforce, Fiverr, Spotify and Sartorius. Here we can see the changes that happened from January to February. We can see that ASML increased a lot by around almost 5% points, went from the 4th largest position to the largest position. Teladoc pretty much stayed even. Then we can also see that Microsoft did a jump up to the 3rd largest position from the 5th largest. We can also see that JD.com is sold, which was my 6th largest position. Actually 5th largest position, never mind. Then I did buy a lot of Danaher, pretty much doubling my position, making it from the 2nd smallest to one of my top holdings. Then I also bought more Texas Instruments, getting them into the top 10 area. And yeah, that's pretty much about it. I don't really focus on dividends, but I did receive a dividend payout from Texas Instruments at $1.15 per share. My annual dividends are around 0.56% yield. 8 out of my 19 stocks pay a dividend, with Sartorius being the lowest yield with just around 0.16, and Nintendo at almost a 4% yield. The majority of my dividends come from Texas Instruments though, since it's a large position and pays a around 2.7% yield I think. And ASML is my largest position, contributes a almost 20% of my dividends, even at the small 1% yield. I also want to briefly talk about my checklist. Checklist for me means the companies in my portfolio that I'm keeping an eye on and want to research more and come to another conclusion maybe. These are for this month Spotify, Nintendo, Xiaomi and Sartorius. Spotify and Xiaomi, I'm just thinking, why do I keep my money in a hard business? The smartphone business and the music streaming business are both very competitive, and at least the streaming the music streaming business has insanely low margins. Spotify has around a 30% gross margin, which is ridiculous for a software and especially for a marketplace model. So I'm thinking, why don't I just, for example, buy more Fiverr, which has a marketplace model too, but they have gross margins around 85%, I think, or like 82%. And just in general, they don't have the big limitations Spotify has with the labels getting an insane part of their revenue. So that was one part of my thinking. Then I'm also want to do a lot of thinking about Nintendo. The company is great, but I just feel like the money might be better in some higher convictions because they are at the lower end of my conviction list. So yeah, nothing wrong with the company, but yeah, I might take some gains here since I'm around break even with them compared to a lot of other companies which are more attractively priced, I feel like. And then the last one is Sartorius, which I don't have anything against. I just need to do my research because I don't understand the business well enough as I would like to. The last thing I want to talk about is my watch list. These are companies that I don't already own, but that I'm currently watching and might decide to add into. The first one is the Home Depot, which corrected by around 25% from the highs in the last month, I think. They are a stable dividend payer and they also do a lot of share buybacks and have a gigantic moat. So I need to find out if they are great at allocating the capital, and I might initiate a position. I will see. Then I also recently did a analysis on Airbnb on YouTube, which I link in the description. I was pretty I like the company a lot, so I'll do more digging and might buy into that. Another company I want to look into is Moody's. They are one of the rating agencies which has a great mode because every company needs to rate their bonds and other stuff, and there pretty much is no way for a new competitor to get into the business because it all depends on the name you have, pretty much reputation. So yeah, pretty much no way some company will get a bond rating from a unknown small company. So pretty much a one of the best modes on the planet. Then the last company is Unity Software, which might be a nice shovel business since they do a lot of software regarding the whole AR segment and also gaming. So yeah, I will look into that one too. So if you liked the video, and if you did, please consider liking the video and subscribing to the channel and leave some comments down below. See you next time.